Hey everyone, and welcome back to the channel. So this is a new portfolio update for the past 2 months. In the portfolio, we've reached an all-time high of $39,300, and we're up 16% all time. And I'll get into my buys in my TFSA. So in the TFSA, we actually have Apple hitting new all-time highs, and it has become one of, if not the best investments I've made since I've started the portfolio. I was buying this around the 140 range, and people as of late were a little worried about Apple's growth decelerating. But there is some news coming out of India that their sales have grown by 33% year over year. So that's an exciting new market, and that's pretty tremendous growth. And we'll see if Apple can increase their profits this year and show a little bit of life in the growth department, just because if they can't, they are going to fall from this lofty valuation that they're trading at now. But we'll see what happens with their new AI push for their new iPhones. And then for Amazon, there is some news that they are starting to sell cheaper items from China and trying to disrupt companies like Temu. So we'll see if Amazon can make a dent into the cheap Chinese online products, kind of the online dollar store where people just want really, really cheap items. If they can, I mean, we'll see what happens with that. But otherwise, Amazon is doing great with AWS and advertising, and that's really where most of the growth is going to come from Amazon, alongside their Prime membership and, of course, the ads that they just introduced on Amazon Prime. And then with ATD, I bought one more share going up to 22. So this one was in the $70 range, but it's now racing back up over 81. So I'll see if this dips. I'll try to get more. With BAM, it's actually trading. It actually went on a little bit of a dip, so there is a little bit of a discount versus BN. So I decided to get one more BAM, get a nice, near 4% yield, since this part of Brookfield does pay out 90% of its earnings through a dividend. So this one should grow quite nicely over time, and I'll want to build this up a little bit more. Costco raised their membership fees by $5 for the gold membership and $10 for the executive. So it should bring Costco an extra $300 to $400 million of profit each year. So, and that just goes straight down to the bottom line, because it's not the low margin grocery revenue that they primarily get from their main revenue. Like the membership is where they make all the profit. Great to see that. And it's only an 8% increase since the last time they've done it. So it's still very considerate of their customer base, but definitely they do need to make money at the end of the day. So I don't think anyone's going to quit Costco over a tiny increase like that. And then with ENS, I bought 19 more shares just because it's in a huge dip, and it was offering a greater than 14% yield for a time when it was in the trading in the $10 range. So definitely gonna get a lot more of this. And if there are more rate cuts in Canada, I do see not only Enbridge but of course ENS to benefit from that overall. We're just not seeing it yet, but we'll see. For Granite REIT, I bought 2.9 more shares of this while it was trading in the high 60s. Now it's kind of come up. It's starting to break even. I hope it kind of comes back down again, but we'll see. But either way, while it's in a dip, I'm definitely gonna keep compounding every single month and reinvesting my dividends into here and just building this real estate company in Canada. For H Yield, I bought 2 more shares. So this is my S&P 500 income fund, and it's up 7.5%. And meanwhile, it is paying me I think I have a yield on cost of about 13% in this fund. So it's doing great, paying me a lot of income every month. And I actually recently deployed that dividend into a new stock. So just hang on a moment to find out what that is. And then with Palantir, I bought one more share in the 24 range. This has been racing up. There's a lot of hype around the company now because AI and the AIP boot camps that they recently started. So the company is expected to grow much quicker than they were before, and they're being taken seriously as an AI player, and they've been profitable for many, many quarters. I'm really excited to see where this company can go. I would like to add more, but I would like to see a dip, but I don't know if we're gonna get it. But either way, I'm gonna hold on to the stock and see where it goes. And then with Smart Centers, I just bought 3 more shares, just getting more rental income every month. It was giving like a 8% yield, a little bit higher, so not bad. Just getting that every single month, and kind of buying more Granite REIT with that. Just because Granite's growing a little bit better. It has a lower payout ratio. They raised the dividend. It's in a little bit of a better shape. So kind of want to split my real estate between these two. This for the high income, and this kind of for a combination of growth and good yield. And then for TELUS, about 5 more shares going to 110, just reinvesting my dividend and then also buying more of it. Those rate cuts should help this stock, even though it's kind of beat up right now. I do think it's going to come back. Same thing with TD Bank. So our Canadian holdings have been doing pretty poorly. And I did notice that my portfolio is 60% Canadian stocks and 40% American. So that's why I decided to add a new position, and that is Visa. So bought 0.82 shares of Visa. I think it's trading at a pretty fair valuation for such a high quality, predictable growth company. They pay a very small dividend. I felt like it was fine to add to a TFSA because we're not going to be too impacted by 15% withholding tax on this. I'd rather have low yielders for US stocks in my TFSA and have the high yield stuff in the RRSP, just because you don't want to be dinged for 15% for like a 5% yielding stock, whereas a sub 1%, not a big deal. And Visa is going to appreciate in share price as well over time. And their payment processor, so they're a duopoly with MasterCard. And the reason I went with Visa over MasterCard was because this was trading at a lower valuation than MasterCard, and they have had similar growth rates in their most recent earnings. So definitely went ahead with Visa, and I'd like to add more to this company I plan to do it for the next few months, so I hope that the price kind of stays around these levels, the sub 300 range, and then I can grow this over time and get my US exposure up a little bit, at least 50-50 with the Canadian exposure, because I definitely want more US exposure in my portfolio overall. And for the dividends earned, I've earned $29.41.99 in dividends since starting the portfolio. Our annual dividends have grown from $16.02 to $16.83.52. And then monthly, we're making nice progress, going from $133.50 to $140.29 a month. And the daily has gone from $439 a day to $461 a day. And notably, our days of freedom, which is how I'm tracking how many days of expenses my portfolio will cover just from the dividends it pays. We've gone from 26.21 days to 27.54. So the ultimate goal would be to hit 365, which means I have my base expenses completely covered by the portfolio. A big milestone will be hitting 30 days, which means I have 1 month fully covered just by the portfolio. And, we can kind of see the progress grow after that. And the hourly wage, if my portfolio were to work a 40-hour work week for me, has increased from 70 cents hourly to 81 cents hourly. So we are getting closer to some of my goals of hitting, $150 a month in dividends on average, and also $5 a day in dividends. And if we look year over year in 2024, we have actually passed over the 2022 total already in just 6.5 months, and I should be getting an extra 100 or so in July. It's going to be higher than April, so it will be a new all-time high for the portfolio, and we are well on track to eclipse what I earned in 2023. So really nice to see not only the market going up, but also that my dividend income is also going up over time. Thank you so much for watching, and have a good one.